Instead of the 4% rule, what we often do is we start off clients something more like 5.3 to 5.8 using green light. But there's a catch. There always is. If withdrawal rates drift 20% above the start, we trim spending 10%. But keep in mind, we were able to start spending 5.5% roughly, plus or minus, often more than that, instead of 4. If spending rate falls 20% below the start, you give yourself a raise. So you're increasing spending a little if your portfolio gets too high, decreasing when you get too low. Because you have these, I call them safety rails. I don't really like guardrails. Because you have these safety rails, it allows you to have the same security as the 4% rule because you're adjusting to reality. And I call it green light. I don't like red light. Green light, yellow light spending is because when things are good, you step on the gas. You make the most of your retirement. This is critical early in retirement.
Welcome to the Healthy and Wealthy Retirement, where your certified retirement counselor, Mark Struthers, takes a holistic approach to retirement, going beyond finances and embracing holistic well-being. This YouTube channel will address not just the financial part of retirement, but also the social, the physical, and the emotional parts of retirement. Everything you need for healthier, a wealthier, and a happier retirement.
Hi, welcome to the Healthy and Wealthy Retirement. My name is Mark Struthers, and today we have an episode that is going to help you. It is either going to help you retire earlier or help you enjoy retirement more, or some combination. The reason being is we often use the 4% rule. And for those of you that don't know, I'll explain what that is, as a way of looking at if I have enough for retirement. And while groundbreaking, certainly you can't say it's the same as curing cancer, but it was certainly groundbreaking for financial planners. I started off in the industry on the operations and trading and then institutional side, working on the CFA. But I've been on the retail CFP side for over a decade, 12, 13 years. And the 4% rule, even before I became a CFP, I knew of the 4% rule. I think most Gen Xers in this industry has. It came out in 1996. And it's not that it's a wonderful rule, but it is what I often tell my sons. It's kind of like working harder, not smarter. There is a smarter, safer approach that gets underused. Now, I will say a lot of advisors like me kind of have used it in the background, depending on the client. But we will often use something called guardrails. We here call our model green light spending, because I think that's more accurate. The more I do this, the more I have worked with families, the more I have seen what family and friends go through. Not spending enough in retirement or not retiring early enough can often be, I don't want to say it's as dangerous or harmful as running out of money, but it is up there. So what is the 4% rule? Built in the 90s. So for Gen Xers like me, we were all coming out of college in the 90s, or most of us. But lifespans were shorter, bond yields higher. And when you read Bengen, and he recently came out with a new book, when you read his original study, it only had 2 asset classes. It doesn't take long in this industry, and it was the S&P 500 and intermediate government bonds, to say for a diversified portfolio that is going to be more effective over the long term, you can do a lot more than with just 2 asset classes. And even his new book has updated that. So his 4% rule now is more like 4.7 and makes it clear, and I think he's come up with the term safe max, that if you use some common sense around what you're doing, that you can spend a lot more than 4.7. The 4% rule is designed around retiring before the worst possible 30-year stretch in history. That includes inflation. So bad bonds, stock market returns, and bad inflation. And that period was not the Great Depression. It was the late 60s. It was the 70s. It was that period. And in order for safe withdrawal rates in order for you to need them, you actually have to have a bad sequence of return and inflation right after retirement. Because if it happens later in retirement, if there's equity exposure, your portfolio has grown large enough to where it usually doesn't matter. And in the case of the Great Depression, if you're curious, it was because the cost of living went down. So that's part of the reason why that late 60s to 70s was retired. I think it was 1968 was where the 4% rule was designed around, or the new 4.7. So what makes the 4% rule harmful, especially as folks are living longer and the risk of not retiring soon enough or dying with too much money has gotten greater, is rigidity. It ignores market conditions and real life spending patterns. And part of the real life spending pattern, when you think about this, and we've worked with clients on this, like a retirement spending smile or stages, and these are terminologies that advisors will use different variations. But usually you do and want to spend early in retirement, and especially now with longer lifespans, you want to be spending in your 60s and 70s when you're healthy enough, because we're living longer, just not necessarily healthy all the way through. And then spending drops. Sometimes it's health. Sometimes it's just they had their fun and now they're ready to relax. And then quite often the no-go years is when spending really drops off. You could think the late 80s to 90s, except for healthcare. That's why we often kind of call it retirement spending smile. So the 4% rule, or the new 4.7% rule, really does not address that at all. So I often see retirees living below their means because they're afraid to cross that 4% ceiling. There's such fear wrapped around it. So we'll give you an example. Jim and Sarah retired with $1.2 million. 10 years later, let's assume some rate of return, they have 1.6, but they might only be spending $55,000 a year, even though their portfolio has grown, their time in retirement has shortened. That's a possible loss on memories. Why would you not take a look at that and say, let's spend more? Now, you don't use this as an excuse to just start spending willy-nilly. You need a plan. The solution is green light spending. So assume you're driving down the road, like a beautiful day right behind me. Well, not anymore. It'll come back up. But say you're driving, and no matter what the conditions, you always drove 40 miles an hour. So you drove 40 miles an hour when the weather was bad and the road was treacherous. And you also drove 40 miles an hour when the road was wide open, a sunny day, could see for miles, great visibility, not too hilly, not too curvy. That doesn't make sense. That's not making the best use of your time and your resources. Why not drive faster when the weather's nice and the road is great, and drive slower when the road is snowy, treacherous, rainy, hilly, curvy? So instead of the 4% rule, what we often do is we start off clients something more like 5.3 to 5.8 using green light. But there's a catch. There always is. If withdrawal rates drift 20% above the start, we trim spending 10%. But keep in mind, we were able to start spending 5.5% roughly, plus or minus, often more than that, instead of 4. If spending rate falls 20% below the start, you give yourself a raise. So you're increasing spending a little if your portfolio gets too high, decreasing when you get too low. Because you have these, I call them safety rails. I don't really like guardrails. Because you have these safety rails, it allows you to have the same security as the 4% rule because you're adjusting to reality. And I call it green light. I don't like red light. Green light, yellow light spending is because when things are good, you step on the gas. You make the most of your retirement. This is critical early in retirement. Why not make the most of those go-go years? Why not work smart, not just hard, and really make the most of your investment car, your investment portfolio? You're going to enjoy the trip more. You're going to get to your destination sooner. I recently had a couple who, I did this behind the scenes. We've always used more than one model to say if someone can retirement. We use scenario analysis, often called Monte Carlo simulation. We work in some sort of 4% rule. We also have conversations about would they be willing to cut back spending if they had a bad sequence of return or inflation right after retirement. Well, this couple was very clear that they weren't going to spend enough really from the start. And they've been in retirement. He's been in retirement for quite a while, her for a few years. She recently bought her dream car, a super large SUV. She's a petite woman, much like my wife, which I'm always amazed when you see these smaller women driving these huge SUVs. To each his own. But the joy that it brought them. He was a mechanic, and he had always brought home cars that I think were junkers, where nothing could be done with them. He fixed them up to where she could drive them for however long, and then did it again. A very inexpensive way. And to see the joy on their face where they bought this car, where they finally got to the point where they felt like, Mark's been telling us this, to see this, for them to use their funds for something that brought her such joy. And this is where in-person meetings often mean more, because the body language, the look in their eyes. So it was pretty cool to see them make the most of their memories. And they've big family people. So this is one of the few really large material things that they have. But they also spend on vacation. So this was cool to see her finally get a dream car after sacrificing for so long. So what this couple had, so that they were spending more in their 60s without jeopardizing long-term security, is a big P word. Permission. Permission, permission, permission. Let's give you another example. Let's say Maria, 61, saved $950,000 plus a small pension. According to the 4% rule, she would have needed $1.25 million and had to have worked to age 67. With green light spending, she can now retire on $50,000 a year plus some cash reserve. When this doesn't include the pension or the Social Security. So she was able to retire 5 or 6 years earlier. And we'll show up a graph of what that looks like. That how much you would need at 4%. So at 4%, she needed 1.25. At the new 4.7, she needed 1.06 million. And then with green light spending, somewhere between 860,000 and $1 million. Those several years in your 60s mean a lot. Several years in your 40s, as you're going through life, go by fast and they don't mean as much. But several years of healthy years where you can spend, just like this other couple, whether it's vacations or that new car, when you're talking 60s, early 70s, is huge. And it's not just retiring earlier. There's some folks, I'll include myself, who plan on working quite a while. And no matter what happens, we will continue to work. Well, that's great. But why have the 4% rule limit how much you spend? So let's take a portfolio of $1 million with the 4% rule. You can spend $40,000 a year, 4.7%, $47,000. But with green light spending, most likely you can conservatively spend $55,000 a year. And all this is adjusted for inflation. That is a big pay increase. Retire at the same day, realize what adjustments might be made. But the key is you're probably going to reduce spending besides healthcare later in retirement. And again, we're still compensating for all the goals and legacies and anything else. But the bottom line is if you have a dynamic spending model like green light spending, you can either retire earlier or spend more. That $55,000 a year compared to 40 or 47 is huge. An extra 15 grand a year is a lot. That's an awful nice vacation, an awful nice car. So retirement is not only about running out of money, it's about permission. Permission to retire earlier, permission to spend more when conditions allowed, permission to enjoy the healthiest years of your retirement. So download our free ebook, Greenlight Spending, to get more detail. And also don't forget, sign up for our free retirement review and see how our Greenlight spending rules might apply to your situation. And if you have your portfolio, your money, and yourself work smarter and not harder, you're probably going to have a healthier, a wealthier, and a happier retirement. Don't forget to hit subscribe. Thanks for tuning in. If you enjoyed this episode, make sure to hit subscribe, leave a review, and share with your friends. Share the love. Make sure they have a healthier, a wealthier, and a happier retirement as well. Also, don't forget to subscribe to our newsletter for free resources and check out our website and social media pages for exclusive content and updates. See you next time.
Sona Financial, LLC, DBA Sona Wealth and Sona Wealth Advisors, is a registered investment advisor with the state of Minnesota. All views, expressions, and opinions included in this communication are subject to change. This communication is not intended as an offer or solicitation to buy, hold, or sell any financial instrument or investment advisory services. Any information provided has been obtained from sources considered reliable, but we do not guarantee the accuracy or completeness of any description of securities, markets, or developments mentioned.